Welcome to the Deep Dive. Today we're zeroing in on the third fiscal quarter 2025 earnings for Affirm. They're the company aiming to, well, offer honest financial products that improve lives, as they put it.
Exactly. And we've got their earnings supplement right here, dropped May 8th, 2025, plus some news coverage digging into it.
Right, so this covers their performance up to March 31st, 2025. That's their fiscal Q3 end. They've also got a shareholder letter out and a conference call happening today, too.
Yep. And their whole idea, fundamentally, is flexible payments for consumers, helping businesses grow. They really push the transparency angle, no late fees, no hidden fees, unlike, well, traditional credit cards often.
That's definitely their brand message. What makes this interesting, though, is the news today. Affirm stock is down, over 10%?
Yeah. That's the headline grabber. Despite the results we're about to unpack, the market reaction is negative. So there's clearly something more going on there.
Absolutely. So that's our mission today. Let's dive into these materials, pull out the key insights, and help you understand Affirm's performance and maybe why the market's reacting this way. Okay, where's a good place to start? GMV.
Good call. Gross merchandise volume. That's basically the total value of stuff bought using Affirm. For Q3 2025, it reached $8.6 billion.
$8.6 billion. And how does that stack up against last year?
That's a 36% jump year over year. It was $6.3 billion in Q3 2024. So pretty strong growth. Suggests people are definitely using these buy now, pay later options more.
And it's not just a spike, right? Looking back, it seems like a steady climb.
Oh, yeah, definitely a trend. It was $5.6 billion back in Q3 2023, so clear expansion. And the average purchase size, the average order value, or AOV, was 273 thrillers this past quarter.
Okay, so more spending overall. What about the number of people actually using Affirm? Active consumers.
Right, that's also up. They hit 21.9 million active consumers in Q3.
21.9 million.
Yeah, that's an 18% increase from the 17.8 million they had a year ago, and up from 16.5 million the year before that. So the user base is growing nicely.
But it's not just more users. It looks like they're using it more often, too. Transactions per active consumer.
Exactly. That number climbed to 5.6 in Q3 25.
5.6 times per user.
Yep, up 19% from 4.7 last year, and quite a bit higher than the 3.9 it was 2 years ago in Q3 2023.
That seems important. It means people aren't just trying it once, they're coming back.
It definitely suggests repeat usage, stickiness.
Yeah.
Okay, so let's talk revenue, the actual money coming in.
Right.
For Q3 2025, that was $783 million. Again, solid growth, 36% year over year from $576 million.
And that's also following that upward trend we saw with GMV.
Precisely. It was $381 million in Q3 2023. Interestingly, their revenue as a slice of the total GMV this quarter was 9.2%.
Okay, now here's something that really jumped out at me from the report, the Affirm card. That seems to be, really taking off.
It really does. The GMV, specifically from the Affirm card, soared. It hit $807 million. That's a 115% increase compared to last year.
Wow, 115%. What's driving that? Just making it easier to use Affirm anywhere.
It seems that way. It suggests they're moving beyond just being an option at checkout, and the number of active card users reflects that too, 1.9 million people.
And how much did that grow?
That grew 107% year over year. It means about 9% of their total active consumers now have and use the card. That's a decent attach rate and shows broader adoption.
Yeah, it definitely feels like they're becoming more integrated into people's regular spending, not just for specific large purchases. What about where people initiate the transaction? Is it mostly at checkout?
Good question. The breakdown for Q3 shows 77% were point of sale, so yeah, online checkout, in-store. But 23% were initiated directly by the consumer through the Affirm app, their website, or using that card we just talked about.
23% initiated by the user. Yeah. That's actually quite a chunk.
Yeah.
Shows the platform itself has drawing power.
It does. It's not just reliant on the merchant integration. Now, looking at the types of loans in Q3, the majority, 72%, were interest-bearing.
Okay.
Then you had 13%, which were those 0% APR loans paid in monthly installments. And the last 15% were the short-term pay in X options, also 0% APR.
And all those categories grew.
Yep, all saw pretty healthy year-over-year growth. Interest-bearing up 38%, 0% APR monthly up 35%, and pay in X up 44%. So growth across the board in their core products.
All right, let's switch gears a bit. What about the businesses they partner with? Which sectors are driving that GMV growth?
They break it down quite nicely. General merchandise is the biggest piece, about a third of their volume, and that grew 38%.
Solid.
Fashion and beauty, that's 14% share, grew 20%. Travel and ticketing, though, really stands out.
How so?
It jumped 81% year over year. It's now 15% of their GMV. Huge growth there.
81%. Okay, travel's clearly booming for them. What else?
Electronics grew 26%. That's 8% share. Home and lifestyle was actually the only one down, decreased 14%. It's about 6% share.
Interesting, a drop there. Maybe post-pandemic normalization?
Could be. Equipment and auto grew 23%, also 6% share. Sporting goods, outdoors up 34%, but smaller at 2% share.
Yeah.
And then a general other category grew 20%, making up the remaining 15%. So yeah, pretty diversified mix.
It really shows the breadth of where they're integrated. Now, back to consumers for a sec.
Yeah.
Including Returnly, that acquisition.
Right, including Returnly, active consumers hit that 21.9 million mark we mentioned, which is 21% growth. If you strip out Returnly, the organic growth was actually a bit stronger, 23%.
Okay. And transactions per active consumer, we said 5.6.
Yeah, 5.6, up 20% year over year, and total transactions in the quarter, 31.3 million.
31 million transactions. That's a lot.
It is, up 46% from last year. And here's a really key stat, I think.
What's that?
Of those 31.3 million transactions, 29.6 million were from repeat customers.
Wow, okay, so that's what, 94%?
Exactly, 94% repeat business. That speaks volumes about customer loyalty and, finding value in the service.
Absolutely. And on the flip side, the merchants. Are they adding more businesses?
They are. Active merchants reached 358,000, up 23% year over year. And maybe more importantly, the number of merchants doing over $1,000 in sales through Affirm in the past year grew even faster, by 27%.
So they're not just adding tiny shops, they're getting traction with businesses seeing real volume through Affirm.
Seems that way. They're adding and deepening relationships with merchants who generate significant GMV.
Okay, let's dive into the financials a bit more. Interest income, how does that break down?
All right, so total interest income for Q3 was $402.7 million.
And that comes from?
Mostly from interest on the outstanding loan balances. That was about $370 million. Then there's a component called amortization of discount on loans held for investment that added about $66 million.
Okay, what exactly is that amortization of discount?
It's basically recognizing income over time from loans they acquired or originated at less than face value. Think of 0% APR loans, where the discount is the fee the merchant pays. They spread that income out. There's also a smaller negative impact from amortizing premiums, and then about $27.5 million net loss from interest receivable they couldn't collect.
Got it. And the average balance of loans they held?
The average interest-bearing loan balance was $6.7 billion. They also held an average of $2.4 billion in 0% APR loans. So about 27% of their average loan holdings were 0% APR.
And that amortization of discount piece seems fairly significant then.
Yeah, it was about 16% of the total interest income this quarter. Definitely a noticeable component of how they generate revenue, especially from those merchant partnerships.
Okay, now costs. What did it cost them to facilitate all this business? Transaction costs.
Total transaction costs were $430.6 million in Q3. That works out to 5.0% of GMV.
And what's inside that number?
The biggest chunk, $147.3 million, was the provision for credit losses. That's money set aside for potential defaults.
Their estimate of bad debt, essentially.
Right. Then you have funding costs, the cost of the money they lend out that was $107.6 million. Processing and servicing costs were $118.4 million. And there was a $57.3 million loss on loan purchase commitments.
Okay, so if you take out that big provision for potential losses, what do the core operating costs look like?
Good question. If you exclude the provision, the transaction costs were $283.3 million, or 3.3% of GMV. Gives you a sense of the cost structure before accounting for credit risk specifically.
So revenue less transaction costs, how does that look?
For Q3, it was $352.6 million. That's 4.1% of GMV. And importantly, it grew 53% year over year.
A healthy growth rate there. And if you look at it without the provision.
Right. Revenue less transaction costs, excluding the provision, was $500 million, or 5.8% of GMV. That figure grew 41% year over year. So still strong growth, even when you adjust for that loss provision.
These metrics give a better sense of the unit economics, maybe. Now the bottom line, operating income or loss.
Okay, so on a standard accounting basis, GAAP, they reported an operating loss of $8.4 million for Q3. That's a negative 1% operating margin, basically break even on a GAAP basis.
But they also report an adjusted operating income, right? And that usually tells a different story.
It does. Their adjusted operating income for Q3 was $174 million. That's a positive 22% adjusted operating margin.
So, a big swing. What are the main things getting adjusted out between GAAP loss and adjusted income?
The big ones are depreciation and amortization, about $59 million, stock-based compensation, that was $76 million, and then enterprise warrant and share-based expense, another $47 million.
So mostly non-cash charges or things related to stock valuation and compensation plans.
Exactly. Companies argue this adjusted figure gives a better view of the core cash-generating ability of the operations. But, GAAP is GAAP for a reason, too.
Fair enough. Okay, let's talk about the loans themselves, the total portfolio size.
As of the end of March, the total platform portfolio was $23.3 billion. That's all the loans outstanding, whether on their balance sheet or off.
And how are those held? You mentioned on and off balance sheet.
Right, so $13.7 billion is held on their balance sheet, not securitized. Another $2.4 billion is on balance sheet and securitized. Then off balance sheet, you have $4.2 billion non-securitized and $3.0 billion securitized.
Different ways of funding and managing risk, basically? And how much capital do they need to hold against this portfolio?
They report needing equity capital equal to 5% of that total platform portfolio, so a capital buffer. And the average time left on these loans is about 11 months.
And do they have enough funding available to keep growing? Funding capacity?
Their reported funding capacity matches the portfolio size, $23.3 billion. But they note that their current loans only use up about 59% of their total available funding lines. They specifically mention a $4 billion unused capacity from a deal made back in December 24.
So it sounds like they have headroom to fund more loans.
Looks that way, yes. Funding doesn't appear to be an immediate constraint based on these numbers.
Okay, crucial topic, delinquency. How are the loans performing? Are people paying back on time?
Always key for a lender. They provide a few charts. One shows monthly delinquency 30 days or more past due, DQ30 plus, excluding those short-term Pay in X loans. They show the trend over time up to probably April 2025.
And another chart excludes Peloton loans too.
Yes, a similar trend line excluding both Pay in X and Peloton for the quarter ending March 31st, specifically for installment loans.
Wow.
The 30-plus day delinquency rate was 2.4%. 60-plus days late was 1.5%, and 90-plus days late was 0.6%.
And how does that change if you exclude Peloton?
Slightly higher. Ex-Peloton for the same period. 30-plus day was 2.5%, 60-plus was 1.5%, and 90-plus was 0.7%. So Peloton loans were performing slightly better than the average, it seems.
And they compare themselves to other lenders too.
They do. They show Affirm's 30-plus day delinquency around 4% as of March 31st, and note they have a 42% mix of non-prime receivables. They plot this against other unnamed consumer lenders who have different delinquency rates and different non-prime mixes. It provides some context, relative performance.
Right. And they also break down their loan book by their own internal credit score, ITTS.
Yes. Gives you a sense of the risk profile based on their assessment. As of March 31st, the vast majority, 68%, or $4.5 billion, was in their highest score bucket, 96 plus seller.
Okay, so mostly top tier according to their system.
Another 27%, $1.8 billion, was in the next tier, 94, 96. Only about 4% was 90, 94, and just 1% was below 90. So heavily weighted towards what they consider lower risk borrowers.
What about looking at loans by when they were originated? And the write-offs, the charge-offs.
Yeah, they show that breakdown too. Unsurprisingly, the biggest chunk of the current outstanding balance, $5.8 billion out of $6.6 billion total held for investment, comes from loans originated in this fiscal year, FY 2025.
Makes sense. Those are the newest loans.
Then for charge-offs in the current period, the largest amounts also came from recent vintages. About $76 million from FY 2025 loans and $57 million from FY 2024 loans, again, expected as loan season and balances are higher initially.
Okay, and the allowance for losses, the pot of money set aside for future defaults.
As of March 31st, that allowance stood at $375 million. That represents 5.7% of their loans held for investment.
And has that allowance percentage been stable?
It's fluctuated a bit, but seems to have generally trended up slightly over the last year or so, reflecting perhaps the growth and seasoning of the portfolio or maybe economic outlook. They show the flow, started with $289 a year ago, added provisions, subtracted actual charge-offs, ending at $375 million now.
Got it. So looking at what's Affirm forecasting for the next quarter, Q4, and the full fiscal year 2025?
All right, the outlook. For Q4, they expect GMV between $9.40 and $9.7 zillion. For the full year, $35 to $36 million.
And revenue?
Q4 revenue forecast is $815 to $845 million. Full year, $3.163 to $3.193 billion. Transaction costs are projected at $430 to $445 million for Q4 and $1.721 to $1.736 billion for the year.
Okay, so what does that mean for their projected profitability metrics?
Revenue less transaction costs is guided to be $385 to $400 million in Q4 and $1.442 to $1.457 billion for the full year. For GAAP operating margin, they expect 1% to 3% in Q4, which leads to a full-year loss margin of -4.3% to -3.8%.
Still a loss on a GAAP basis for the full year then, but adjusted.
Adjusted operating margin, they're guiding for 23% to 25% in Q4 and 23% to 23.6% for the full fiscal year. So continued strong profitability on that adjusted basis.
And what are the key assumptions behind that outlook? What could change things?
They mention a few things. They expect a continued shift towards more 0% APR volume, including Pay and X. They also anticipate GMV growth will moderate a bit in Q4 compared to the pace they saw right at the end of March, April.
Okay. Anything else?
They expect warrant expenses similar to Q3. They think their equity capital ratio will stay at or below 5%. And interestingly, they say new initiatives like the Affirm Money account, their B2B product, UK expansion, they don't expect those to have a material financial impact in Q4. Same for a recently launched wallet partnership.
So focusing on the core business performance for the immediate outlook.
Seems that way. Manage the core, integrate the new stuff, but don't bake in big contributions from the newest ventures just yet.
The report also gives a fully diluted share count estimate.
Yeah, as of May 7th, they estimate it around 352 million shares. That includes common stock, options, warrants, the CEO award, RSUs minus treasury stock. Gives you a sense of the potential total share base.
And lastly, a quick note on share-based payment expense.
Right, they break that down too. Shows the components over time, employee stock comp, the CEO award amortization, costs related to those big commercial deals with Shopify and Amazon. The Q3 total is in the details.
Okay, so let's try and wrap this up. We've dived deep into Affirm's Q3 results. We've seen pretty significant growth pretty much across the board, right? GMV, active consumers, revenue.
Definitely strong top-line growth. And that Affirm card growth is really notable, potentially transforming how they're used.
Yeah. We also looked at the costs, the transaction costs, the provisions for losses, and that, important difference between the GAAP operating loss and the adjusted operating income, largely driven by stock compensation.
And we have their outlook, projecting continued growth and strong adjusted margins, though still a GAAP loss expected for the full year.
So for you listening, what does all this tell you? What's your read on the buy now, pay later space and Affirm's position in it based on this? How do you interpret those delinquency numbers and the loan portfolio quality?
And importantly, how do you square that strong reported growth with the negative market reaction today? The stock dropping over 10%, it suggests investors are perhaps worried about something else.
Right. Maybe it's the path to consistent GAAP profitability. Maybe it's competition intensifying. Maybe broader economic concerns about the consumer. Things not explicitly spelled out as problems in this report, but maybe weighing on investor minds.
Exactly. Which leads us to a final thought for you to chew on. Affirm's mission is about honest financial products improving lives. Looking at these results, the growth, the user engagement, but also the costs, the delinquencies, the reliance on adjusted profitability metrics. What do you see as their biggest opportunities and maybe the biggest challenges in actually fulfilling that mission while also driving sustainable growth?
What other questions does this raise for you about where consumer finance is headed? Something to think about.